Hello, everyone. This is Tom Fox. Welcome back for another episode. And I'm thrilled today to have with me Sheetal Parikh. Sheetal, first of all, welcome. And thank you so much for taking the time to visit with me today.
Thank you for having me.
Could you tell us a little bit about your professional background?
Absolutely. I've been practicing attorney for over 18 years now, mostly in financial services. Started my career more in the litigation space, doing securities and commodities litigation, and then spent some years in house at Morgan Stanley's legal department. Spent some years as a regulatory attorney at a money services business, and am now at Treasury Prime as the Associate General Counsel and VP of Compliance.
What does that mean to have dual roles as Associate General Counsel and VP of Compliance? Is half of you legal and half compliance? And if so, which half?
It's interesting. I like to think I'm in whole part serving both roles at all times. I wish I could clone myself sometimes. Yeah, I think there's such intersectionality between the regulatory work I do in the compliance space and then the product legal work and then true compliance work with bank compliance department. So that really encompasses the full suite. I also spend some time on the transactional side with contracts and helping the sales motion.
So, what is the primary business model of Treasury Prime? Is it products? Is it services? Is it a combination of both? Could you just describe the company for us?
Sure. So we're a software technology company that enable banking software, so banking products and services. So we really like to think of ourselves as the piping that sits in between banks and other fintechs looking to embed banking products and services. So we really like to connect through our APIs bank technology with other companies and embedded finance companies that are looking to embed some of these services. So if you're a startup wanting to offer direct deposit or ACH functionality, you would hook into our software and we would enable that through our bank partners.
She tell us many of the listeners to this podcast are compliance professionals. So could you tell us how Treasury Prime really helps or facilitates building out a compliance program in a financial institution?
Yeah, we've put a lot of thought into how we want to think about compliance and what role we want to serve as the software technology company. There are some of our competitors that take the position you can offload some of those functions and we'll do it for you. That's not our model. We don't think it's scalable, nor is it necessarily positioning our bank partners or our fintech customers for success. So our model is we're not going to do it for you, but we will do it with you and we will give you a toolkit and a set of tools both through our technology and through our expertise that allows both the banks and the fintechs to stand up a program that everyone is really comfortable with.
One of the things that really struck me about information on your website that I wanted to explore with you is what in the non-regulatory space,
Mhm.
the regulators in the form of the Department of Justice say, which is every business's risk is different. And therefore, there is no one size fits all. You say that, you guys say that's true in your industry as well. So could you expand on that a little bit for us?
Yeah, our approach and part of really precipitated our approach to how we want to offer compliance services and really not this idea of not offloading it. The idea and at the heart of a true robust risk management program is understanding a company's risk profile, its use case, and that's always going to vary so dramatically based on what a company is trying to do, the types of customers that are interacting through its app or through its platform, the geographic area. And so we do think that everybody's compliance program is bespoke to its model, its use case, its volume, its complexity. So this is really the idea of we can't offer you a one size fits all, a plug and play, but what we will offer you is a set of tools and a framework that then you work with the bank partner to actually establish appropriate guardrails as you see fit for your business use case.
You've used the term offload a couple of times. I want to translate that into legalese
Yeah.
because I've been practicing law a long time. And literally the first 6 months of my practice of the law was in 1983. The Texas Supreme Court held that safety at a corporation was a non delegable duty. And what
Hmm.
that meant was every company is responsible for its own safety. You can't bring in consultants, but it does mean it's your issue. And I've always thought about risk and risk management that way. I know you guys are not talking about a non-delegable duty from the Texas Supreme Court created by law, but
Hmm.
you seem to be saying, I don't want to say the same thing, except in the business context. Would that be a fair assessment?
Absolutely. And I think the banking laws and regulations very much resonate with the Texas Supreme Court example. It's this idea of safety and soundness, and that duty is always going to be with the bank, the regulated financial institution. So you see, as electronic payments and this idea of technology and fintech partners, as it's growing and as people are consuming financial services in a different manner, you do see some banking as a service companies and some of our competitors that will say, let us do some of those functions for you. We're acting as a delegate of the bank. We're going to do things like the know your customer, the KYC. We're going to do things like the transaction monitoring. We don't think that's scalable, or is it really appropriate for either the bank partners and for the fintechs. And I think we're seeing some regulators honing in on this topic as well.
So, my impression of the banking industry is it's rather conservative, very traditional, but you used a phrase of, I believe, customers, either banks were offering new products or customers were consuming bank services in a different way. And that really struck me that, perhaps I need to revise my thinking of banks being so traditional and conservative industry that leads to the need for many of the services you've described that Treasury.
Absolutely. I think particularly in this post-pandemic world, where if you think about it, when consumer of financial services isn't going into a brick and mortar bank branch. Most of, I would say, I think this stat is like 60 to 75% of Americans are actually transacting and banking through mobile apps, whether it's the bank's mobile app or through neobanks or some of these other alternative channels. So I think it's really led to synergy with mostly the community and like the mid-sized regional banks, where there is a growing need to grow deposits and have other alternative channels to acquire customers. And that's where I think the synergy with fintech and technology fits squarely with some of these regional and community banks looking to grow channels.
And I really wanted to focus on the regional and community banks because I live in a rural part of West Texas and we have no major banks. There's only, we have a lot of banks in our city or
Yeah.
town, but only one has a charter even. And so how do you see, or how do you, maybe the better question is, how do you counsel a customer, client, or potential customer about compliance rules and regulations down to the regional and community bank?
Yeah, and most of our bank partners do fit that profile. We have some banks that would be larger, more loan money centers, but the average profile of our bank customer is this regional mid-sized bank. And so I think where we start is the program doesn't really have to be different than their core program. I think that principles and the tenets of risk management are consistent with this alternative channel than what they have with their core banking customers. I think the key is how to identify the differing types of risks. So, for example, a lot of what, from a financial crime, money laundering perspective, a lot of these regional banks will focus on traditional patterns and anomalies, things like structuring, so cash in, cash out. These alternative channels, nobody's really using cash, right? Everybody's transacting through the mobile app. There's a lot of ACH, there's a lot of wires, card payments. So, how do you define risk in this new channel? And that's where really where we fit in is we've seen this from both perspectives. And a company like Treasury Prime, we're built on banking. Our founders are ex Silicon Valley bank executives, and so they understand this space. But we also understand technology, and so that's really the intersectionality of technology and financial services is where we feel like we're not going to counsel you to how you run your program, but we can alert you to trends. We have vendor integrations, we have collateral, and then our own experience. And that's really what the starting point is. And then the bank gets to pull the levers, right? The bank gets to decide its risk appetite and what fits with its broader comfort zone.
What are some of the potential repercussions of failures to meet these regulatory requirements? So once again, do could a bank examiner show up and simply review a compliance program or other risk management strategies? Is a bank safe until something happens? How do you really counsel someone to utilize the tools you've described in a proactive manner?
Yeah, I think we've seen this play out in real life, right? With Blue Ridge Bank and some of the other consent orders out there. We've seen banks we've seen bank regulators come in and say, we're absolutely not comfortable with how the bank is managing risk here. And so I think in a lesser degree, you can face things like economic fines, but at a much greater level, losing the charter and shutting down activity in this entire portfolio. So I think how we approach this is it doesn't have to be so attenuated. We don't say you have to go from 0 to 10. No bank is going to be shut down based on isolated violations. But what we really want to do is make sure we're setting them up for success. So how do they document how they're seeing risk? What kind of third party controls? And that's really a buzzword you're going to hear a lot in this space, is this idea of third party risk management. And so I think what we see regulators saying is, hey, bank, if you're leveraging technology and you're leveraging these service providers, it's the buck still stops with you. So you really do need to understand you have control over what and who is interacting, because these are still bank accounts, these are still banking products and services. So really understanding the type of activity that's occurring, the type of fintechs you're onboarding. And then we talk a lot about automated controls as well. And I think that's something that gets overlooked, but having an ability to put transaction limits or things like card limits, MCC codes, a way to really make sure not just that the bank is aware, but the bank has an ability to stop certain transactions or certain limits that are beyond its comfort. So those are the types of things that I think regulators look at. And then obviously you have to document these things and making sure that the bank team and the bank compliance teams are all in sync with what some of these controls are.
You had a term on your website I wanted to ask you about, and it was embedded finance.
Mhm.
Can you tell me what that means?
Yeah, people are probably going to give you different definitions, but I'll tell you how we think of embedded finance. We think of embedding financial services. So it could be a very simple example like Starbucks looking to embed a way for its users to buy coffee through an app and actually reload its Starbucks card through the app. That's actually an example of embedding financial services into an organization whose core business is not financial services. So there's a quote from a one of the Silicon Valley investors that says every company is a fintech company in some way. And I think that the thought there is, with the evolution of how people are interacting and actually transacting with their bank accounts, every company at some point is going to have to embed some level of financial services into the fabric of their organization. That's how, at a high level, we think of embedded finance.
Also, since I do live in a smaller town with regional and community banks, I really think about things like Silicon Valley Bank and the fallout from that. Are you seeing a greater regulatory, I don't want to say oversight, but maybe paying more attention to banks that perhaps in the past didn't get as much attention?
Absolutely. I think a lot of people would argue that SVB was, and obviously there are a lot of theories and it's no one isolated factor that led to the fall, but it is that category of banks that were traditionally regulated by Dodd-Frank, where those regulations were relaxed a bit as it relates to stress testing and the risk of its portfolio, things like that. So I do think that the liquidity risk and even diversification of the bank's own assets and portfolio are going to be scrutinized more. We're seeing that with Basel Endgame and certain other regulations that are that are in the notice rulemaking process now. Beyond just liquidity and actual bank safety and soundness, I do think there's immense pressure on banks. I think regulators acknowledge technology is important and it's here to stay, but I think there is a lot of pressure to make sure they're innovating responsibly. And I think that's the key, is a lot of these banks are going to need to innovate, probably some of the banks in your community, to actually stay relevant and to stay afloat. They're going to need some alternate channels, but that doesn't give them carte blanche to ignore their fundamental responsibilities as as a regulated financial institution.
Let me take things in a little bit different direction because I have wondered over the past maybe 6 months or 12 months. The entire story of crypto and DeFi to me has re-emphasized the importance of our banking system. And it's emphasized it because of stability. It's been around obviously a long time. It's well regulated, even if you think it's over regulated, but at least there's a place that you and I can advise clients on. It, are people in your industry having that kind of conversation that as important as banks have always been, they're actually more important now?
I think so. I think we hear it from the highest levels of government as well. Michael Su is the acting controller of the OCC. He has spoken a lot about crypto and how even with the fall of crypto and Terracoin, the government and the Treasury hasn't been so impacted so much because they took what he calls, I think he says, cautious but careful approach. And so he almost distinguishes that from the credit crisis and the financial crisis in 2008, where maybe we did become a little too enamored with the financial products and the leveraging of tools out there. Whereas I think with crypto, I think the OCC feels very comfortable with the fact that it didn't have such a dramatic impact on like the financial ecosystem in the US. And so I do think that it goes back to this theme of responsible innovation. I think that innovation is going to be incredibly important for financial services, but it's how we innovate and not losing sight of consumer protection regulations and really responsibilities we have to end users.
So, Tom, where do you see the regulatory framework and scheme down the road to 2030 and perhaps even beyond?
Oh, wow. I think it's inevitable we'll see some more direct regulation for some of these financial technology companies that are offering banking products and services that are acting like a bank. We've seen again the OC say if you're acting like a bank, you ought to be regulated like a bank. And there's this talk about having more of a level playing field, that you have these bank like actors that are not really necessarily held to the same standard. So I do think that there will be some more direct oversight and direct regulation. Today, these technology companies are mostly only being regulated almost indirectly. It's through the bank. The bank almost acts as their regulator because the bank is the regulated entity. I think we're going to see a world where, and it may be gradual, it may be the larger players that are regulated first, or there might be some asset limits or thresholds. But I do think that we are trending in that direction, that as these services are more widely adopted, I think there will be some more direct oversight, direct regulation.
Sheetal, unfortunately, we are near the end of our time for this episode. But before we leave, I wanted to ask you if our listeners wanted any more information on yourself, on Treasury Prime, or really in the topics we've touched on, what might be the best place or places they could go?
Sure. We have a lot of content on the Treasury Prime website. We have a blog as well. So treasuryprime.com. Any questions specifically can be emailed to marketing@treasuryprime.com. And then you can find me on LinkedIn as well. Any specific questions?
I wanted to thank you again for taking the time to visit with me, and I look forward to continuing this conversation.
Thank you so much. Great to meet you.
This is Tom Fox again. Thanks so much for listening to this episode of the award winner, Data Driven Compliance. If you've enjoyed this episode, I hope you'll subscribe, rate, and review wherever great podcasts are listened to. The award winning Data Driven Compliance is a production of the Compliance Podcast Network.